10.1 million barrels of oil vanished from the global supply chain in exactly 30 days. The global energy market has violently ruptured. While a lot of retail investors are out there praying for Federal Reserve rate cuts that are simply never coming, institutional capital is quietly executing a $1 trillion rotation into physical infrastructure. Welcome to our latest explainer. Today, we're exposing the data that Wall Street is trying to keep quiet regarding the AI physical constraint crisis, and unpacking the exact paradox we're facing in 2026, a historic oil shock colliding with a booming U.S. stock market.
Quick reminder before we get into the heavy metrics. This briefing is for institutional and educational purposes only, so always consult the licensed fiduciary before executing any trades. All right, let's look at the greatest forecasting failure of the decade. 10.1 million. That is the staggering number of barrels of oil per day that have been knocked completely offline. Wall Street had modeled a very comfortable oil surplus for this year. Instead, conflict has choked off the Strait of Hormuz, and we are witnessing the most severe energy rupture in human history.
But here is where the paradox really kicks in. Despite that energy crisis, Wall Street giants like Morgan Stanley are out there boldly projecting the S&P 500 to hit a towering 7,800 by year-end. This is being driven by a massive 17% surge in corporate earnings. How is the world facing a catastrophic energy bottleneck while U.S. equities prepare for an unprecedented bull run? It's wild, right?
To make sense of it all, here's our roadmap for today. We'll quickly move through the historic oil shock, the reality of sticky inflation and tariffs, the massive U.S. fiscal boom, the reality of the AI build-out, and finally, how all of this is deeply fracturing the global economy.
Okay, part 1. The historic oil shock and the closure of the Strait of Hormuz.
Looking at the latest data from the International Energy Agency, it becomes glaringly obvious that this is not just a temporary dip. We are witnessing profound structural demand destruction across the globe. With roughly a fifth of the world's crude oil basically stranded, global observed oil inventories are in freefall. Floating storage is completely backed up, and refiners are desperately scrambling to secure replacement cargoes.
You can literally track the domino effect right here. It started with military strikes back in February, leading directly to the effective closure of the world's most critical shipping lane in March. By April, North Sea dated crude was skyrocketing to a massive $130 per barrel. But the real structural earthquake happened in May, when the UAE just unexpectedly pulled the plug and exited the OPEC alliance entirely. That completely fractured the cartel's ability to stabilize anything.
Moving to part 2, tariffs and sticky inflation, or really, the true cost of protectionism.
The Federal Reserve is effectively trapped right now. If we isolate the impact of 2025's aggressive new tariffs using this St. Louis Fed data, you see exactly why. Core PCE inflation is sticky and elevated at 2.90%. That is driven almost entirely by brutal tariff pass-throughs. If we didn't have those tariffs hitting consumer goods, inflation would be sitting comfortably down around 2.49%.
We are witnessing a stark, violent reversal. All that disinflationary relief we felt a year ago, it's been completely erased by a historic 11.8% effective average tariff rate, which includes a punishing 50% spike on metals. Inflation is structural now. The old rules are dead. Look, if you want to survive the capital rotation of 2026, hit the subscribe button right now. We track these institutional money flows daily, and you really cannot afford to trade on outdated assumptions anymore.
Let's pivot to part 3, the OBBBA legislation and the U.S. boom.
So, with inflation and energy costs soaring, you have to ask, how hasn't the U.S. economy completely buckled? The answer is the sweeping 2025 OBBBA legislation. It is functioning as a massive front-loaded stimulus package. You can see the after-tax income boost here. It's targeted but uneven. The bottom 20% sees a 2.6% bump, but look at the upper middle class right there. They are getting a massive 6.3% increase in their after-tax income, and that is driving serious domestic consumption. As MUFG points out, this $4.5 trillion fiscal package is an absolute game-changer. By restoring 100% bonus depreciation, it is triggering a domestic capital expenditure supercycle. Businesses are aggressively pouring money into new physical assets and machinery, offsetting the heavy drag of those tariffs just when the U.S. economy needed it most.
Which brings us to part 4, AI physical infrastructure, and this trillion-dollar rotation we keep talking about.
The broader market assumes AI is just going to magically save us, that it just scales in the cloud infinitely. The market is catastrophically wrong. We are hitting what's known as the AI wall. AI requires pouring concrete. It requires massive copper wire supplies. Physical constraints, specifically intense power grid failures and water scarcity, are completely throttling data center expansion. At $10.7 million to build just a single megawatt of capacity, keeping these servers running is a brutal physical undertaking.
And because primary tech hubs are completely tapped out on electricity and land, institutional money is migrating. They are aggressively targeting secondary, power-rich markets. We're talking places like Kentucky and Ohio, and internationally in Malaysia, Thailand, and India. They are trying desperately to build out the 5.2 million square meters of necessity-driven infrastructure required for this AI revolution.
Finally, Part 5, the global economic fracture.
We are operating in a K-shaped, totally fractured global economy. Anyone assuming a smooth, unified global growth rate right now is living in a dangerous illusion. The United States is surviving on the sheer brute force of AI capex and OBBBA corporate tax cuts, projecting 2.3% growth. Meanwhile, China has basically transitioned into an electro-state, flooding global markets with cheap EVs and batteries to try and export their way out of a severe domestic deflationary trap. In Europe, they are under siege, their industrial base hollowed out by Chinese dumping and an energy crisis that's rewriting the rules.
This divergence is perfectly captured by looking at the central banks. They are literally pulling in completely opposite directions. The Fed is stuck holding rates due to tariff inflation. Europe might actually hike rates despite being stagnant, entirely because of the energy crisis. Japan is tightening its belt, and China is aggressively easing to fight deflation. There is no unified global policy anymore.
So, what does this all mean for you? At the start, I mentioned a secret rotation, the ultimate shield against the stagflationary spiral of 2026. It is the precise convergence of digital leverage and physical scarcity. Smart money is buying the physical world. They are abandoning European debt, buying the land that houses the AI, buying gold as a hedge against geopolitical fragmentation, and buying the raw copper that powers the entire revolution. Without copper, that $3 trillion data center built out just halts. Stop betting on rate cuts and start looking at physical infrastructure. The billion-dollar question you have to ask yourself is, in a world facing historic oil shocks and fractured trade, can the sheer brute force of American AI investment truly sustain this divergence? Thanks so much for joining me for this explainer, and I'll see you next time.